live the AMP Head of Investment Strategy and Chief Economist, Shane Oliver. Shane, we spoke earlier in the week. You said anything with a 6 would basically mean rate hike, and then you thought even recession following that. This is not too far off. What's your response to what you've seen today?
Look, it's not as bad as it could have been. I think if we had a 7% increase, which is what the union movement was after, it would almost certainly mean a rate hike next week. That a 7% increase would have added 0.4, maybe 0.5% to the rate of growth in wages compared to what we've been seeing over the last 12 months. And that would have taken us above the 4% comfort zone. This outcome, is sort of in between. 5.75% is still a step up. On our rough calculations, it will see an acceleration in wages growth by about 0.25, 0.24%. So if you think about wages growth currently running along at 4.7%, if you add this in, which is a step up from what we saw a year ago, then it does take the wages growth number close to 4%. So it will still concern the Reserve Bank, and particularly when you put that together with the increase in aged care wages, increased removal of public sector caps in New South Wales and Victoria and so on, and the strong labour market. So the risk is still there, but it's not as bad as it could have been. And it is nice to know at least that the Fair Work Commission did take account of not being perceived to sort of add to inflation expectations via some sort of wage indexation approach. And they also took account of low productivity at present. So that's a positive. But the problem is it's still a step up from what we saw last year. It still runs the risk of wages pushing above that 4% zone, and that will concern the Reserve Bank.
So that'll be the interesting question. We had markets overall, if you like, saying, I think we had a bump up from 25 to 33% as to whether there'd be a rate hike. This was after the inflation figure was out. This decision now, where do you think we're headed, or if you like, put your own percent on it? What percent of a rate hike from this decision today?
Look, for next week, look, we have decided to put in another rate hike. We were of the view that rates had peaked. Obviously, the Reserve Bank's concern about wages growth, poor productivity, the wage decision, still being an uplift from what we had last year. So we've decided to put in another rate hike in our expectations, which will take the cash rate to 4.1%. It's most likely, I think, to occur in July, but it could come as early as next week. So I would put the probability of a rate hike next week at around 40%. When I last looked at the money market, I think it was still around something like that, maybe 35% chance.
Okay.
But I think we probably will see another hike out of this. The Reserve Bank is clearly quite concerned about entrenching high inflation expectations. And today's decision isn't as bad as it could be, but it does unfortunately still run the risk of putting more upwards pressure on wages and wage perceptions. Because don't forget, when you hear that 20% of workers are getting a 5.75% wage rise, that influences wages settings in the rest of the economy, not directly, but indirectly.
Yeah.
I don't want to be a spoil sport here. I understand why workers want to keep up with inflation. We all do.
Yeah.
But the best approach is to get inflation down. And the easiest way to do that is at present is to not have wages chasing inflation higher.
The Fair Work Commission was saying, here's the impact on last year's decision, 10% of the total wages increase. But as you point out, that's direct. Indirect, we don't know, but you'd have to think there's some increased element of that as well. Anyway, I'll leave that debate for others. Just to clarify on your view then, I say you and the plural in terms of AMP, when you say one more rate rise, so 40% chance next week, you're saying June or July, is that change in position a cumulative effect of both higher than expected inflation and I guess you're saying a slightly higher than expected minimum wage decision today? Those two factors have just pushed you to say one more rate rise. Is that fair to summarise?
That's right.
Like that?
And that's right. It's the CPI number. It's the wage decision, all in the context of what the Reserve Bank Governor was telling us in the last week or so, which have pushed us towards that extra hike. It's not something I would want to do. I'm increasingly concerned that the economy is under a lot of downwards pressure, falling real retail sales, Business investment growth looks like it's slowing down. We saw building approvals earlier in the week not looking very good. Job openings are starting to slow. So I think the Reserve Bank should be pausing for several months here. But I also understand their concerns, and I mean they do have a responsibility to get inflation back down. So, and also we have to listen to what they're telling us. We're forecasting what they would do, not what I would do. So that's where I stand on it. But yeah, it's the cumulative impact of the higher inflation number, the wage decision coming on the back of what the Reserve Bank governor's been telling us.
All right, Shane Oliver, appreciate your time today. We've had you before and you're after now, so we'll see what the RBA says next week. Thank you.